So at the end of any financial period, the fiscal period, we have to do something called closing entries, right? We're basically making journal entries to close out certain accounts, right? So why are we closing out accounts? Why do we want to get rid of any accounts at all? Well, the reason is that we actually have two types of accounts. We have real accounts, which are also known as permanent accounts, right? Those are things like cash and so forth. So this is assets, liabilities, equity, all the things from the basic accounting equation. Those are permanent accounts. They always stay. We don't close those out. But there's this other type of accounts, which is called nominal, right? So this is nominal, or we can think of it as temporary accounts. Okay, so why would you have kind of a temporary account? What is going on here? Well, we have to think about things like revenue and expenses and dividends. When we think of, let's just take, for example, expenses. When we think of expenses, what we really want to do is we just want to take expenses for a particular period, for a quarter, for a year, and we just want to say, what are the expenses for that quarter, for that year, because ultimately what we're going to do is we're going to use the revenue and the expenses. We're going to take the net amount of those two, and that's going to be our profit, our bottom line. That's going to give us our profit. The revenue minus the expenses, which is something we'll get into in a later video. But so we've got our profit, and ultimately this is just a measure for a quarter or for a year. We don't care ultimately every expense that this firm has ever had. We don't want to go and say, okay, how many expenses has IBM had since 1901? We really don't care. We just want to know for a specific period. We want to measure the profitability of the firm. And of course, for dividends, it's a little bit different. We're just saying, well, look, we don't care how many dividends you issued since 1935. We care this quarter, this year. That's what an investor wants to know in terms of dividends. However, when we think about something like an asset like cash, now the investor does care about what is the running tally of cash, right? I don't care what cash was 60 years ago. Now I care what is the running balance of cash, right? Because that means something to me, whereas how many expenses we've ever had in the last 100 years, that doesn't, right? So certain things are just temporary. We want to look at profitability or some kind of measure for a quarter or for a year, something like that. And then other accounts are going to be permanent, right? We're not going to close out the cash balance and say, okay, we don't care about cash before today. We're just going to look from this period going forward. No, we don't do that. We care what is a running balance in cash. So that being said, at the end of a period, we need to close out these temporary accounts, right? We need to close them out. And what we're ultimately going to do is we're going to close them out to permanent accounts. That's what we're doing. We're basically saying we're going to take the difference between revenue and expenses. That's going to be profit. And we can think of that as affecting equity. Right? Now, let me try and explain it in terms of actually showing you some entries, and it might make it easier to understand. So, let's say that for this given period, so in our example, we'll say that for the year or the quarter, whatever, revenue was 100, expenses were 40, and then dividends were 15. Okay. Well, we can't just say, okay, well, next period, if revenue is 20, then we've got revenue of 120. No, it doesn't work like that. Okay, it does not work like that. What we want to do is we want to close out the revenue so that it goes to zero, right? So that's ultimately what we need to do. So we think, well, how do you close out revenue? So let's think of the T account. So you got a T account for revenue. Revenue has a credit balance because remember we said it ultimately affects equity. So we've got revenue of 100. Okay, how do we close this out? How do we make this zero? Right? So if we got credit of 100, you just debit it for 100. And then what happens? You got a debit and a credit, so it just ends up being zero. So ultimately we need to debit revenue in order to make it zero. That's what we're trying to do. And so we're just going to make some journal entries to that effect. So So let's say this is December 31st, 2016. You've already put together the financial statements. You've taken care of all those things, right? We obviously we put the revenue in the income statement. We did all those things, and now we're going forward to 2017, and we need to close out these temporary accounts to some permanent accounts. So what we're going to do, we're going to debit revenue, right? Because we said that we need to debit it. It had a credit balance, and we debit it, and that makes it 0, right? So we just debit revenue for 100. Now, what do you credit? Well, we're going to credit a really strange account. So we're just going to. It's called income summary. Right now, this is itself just a temporary thing. This is actually just something to kind of facilitate ease of use, although it might actually make it a little bit harder for some people. Technically, I guess you could just go ahead and you could just directly credit retained earnings, but it's just by convention people use this kind of income summary account. So I want you to be aware of it. So you just debit revenue, and then income summary is just the opposite. Just to make it balanced, you credit income summary for 100. Now we know that the expense was 40, right? Now an expense, we think about revenue is a credit balance. Well, an expense has a debit balance. So if we looked at the T account for expenses, it would have a 40 debit balance. So what do? Well, we credit it, right? So let me just change colors here. So we're going to credit expense, right? So we're going to credit that for 40 to make that 0. And then again, now just to make this balance, just to balance things, we debit this income summary thing, right? So income summary is going to be 40, right? So now let's take this income summary thing and let's just make a T account for it, right? So we take a T account here, and now let me change colors again. So income summary. So what did we do to income summary? Well, ultimately, we credited it here for $100, right? And then we debited it here for $40, okay? So what happens? Well, this ends up being a $60 credit balance, okay? So ultimately, we now need to zero out income summary, right? So we need to get rid of this. We need to close this out. That's why I said it might be a little easier if you thought about it in terms of just saying, okay, debit revenue, credit retained earnings, and then debit retained earnings and credit expense. But I just, as I said, it's I don't know why, but people use this income summary account, so we're just going to make sure that you're aware of it. So now you need to close out income summary. And so to close that out, so you got a $60 credit balance, what do? What are you going to debit this by to get rid of it, make it 0? Well, you just debit it by 60. Right, so you'd make a debit of 60, and then that's going to make it 0. So now we have to make an entry for this. So we debit income summary. I guess I'm running out of space here. So we got income summary. We'll debit that by the by 60, and then we're going to just, what are we going to credit? We're going to credit retained earnings. Just REL. I'll simplify it here. Credit retained earnings. Okay. Retained earnings is an equity account. Crediting it is going to increase it, right? So what are we even saying here? Well, we're saying that ultimately, if we think about it like this, we had $100 in revenue and we had $40 in expenses, right? So we had $60 of profit, bottom line profit. And we're just adding that to retained earnings, right? That's just earnings that have been kept by the firm over time, right? And this income summary thing is just kind of a way to kind of temporarily capture this $60 of profit, and then we just close it itself out, make it 0, and then just bring it directly into retained earnings. The way I suggested earlier of just directly doing it to retained earnings, well, that's just kind of cutting out the middleman, so to speak. Now, what do we do with dividends? Well, dividends doesn't go through this income summary kind of weird account, but in any event, I mean, dividends still does affect retained earnings, right? You're paying out some of the profits that have been earned by the firm. So dividends is going to decrease retained earnings. Okay, so what do we do with that? Well, retained earnings it's an equity account, so it increases with a credit. It's going to decrease with a debit, right? So all we're going to do is we're just going to debit it. Now, if you remember the dividends, I believe there were 15. Yeah, 15 of dividends. So we're going to debit retained earnings. So let's put our entry here. Retained earnings. We debit for 15. And then we're going to credit dividends. Because remember, dividends naturally has a debit balance. So by just crediting it, then we zero it out, right? So like, let's say we had dividends over here. Here's our T account, and we were sitting at 15. And we're like, hey, how do we get this to be 0? How do we get it to be 0? What do we have to do? Well, we credit it by 15. And that's what we're doing here. This is indented. This is a credit. We credit dividends by 15. We debit retained earnings by 15. So ultimately now, dividends are 0. And if we think about our expenses, our revenue is 0. Our expenses are 0. So we closed out our 3 temporary accounts, revenue, expenses, and dividends, and ultimately we closed out these temporary accounts and ultimately put them in retained earnings, which is a permanent account. Retained earnings will just continue forever going forward.